Thanks so much for tuning into this edition of The Talking Point. I'm your host, Neeraj Shah. We've been toying with this idea or this conversation around whether for some industries has the turn of the decade, due to COVID and due to a lot of other factors, whether the turn of the decade is decisively different from what the business used to look like in the preceding decade or decades, whether in India or globally. Now, hotels is a sector that you obviously have to look at it from an Indian perspective, because Indian hotel business would be very different from the global hotel business. And I think the next 15 minutes will give us an insight into one of the premier hoteling minds about how does he see the business as it is versus what it used to be. And is it possible to kind of predict a blue sky scenario for a supply-starved industry for the next few years, if not the entire decade? Mr. Patanjali Keswani, Chairman and MD of Lemon Tree Hotels, joins me right now on the show. Mr. Keswani, great having you. Thanks for joining in.
Thank you, Neeraj.
I'll start off with that question. Is the probability of this decade materially different than what the previous decade or the previous decades have been? Is the probability really high?
Yes, it's very clearly there are two big changes. One is that unlike the previous decade, supply injections are going to be very, very limited. Demand in India has grown on an average basis for branded hotel rooms at roughly 1.5 times the rate of growth of the GDP. Okay, so the GDP, and I mean on real terms. So GDP growth is 7-8% in the past 10 years. Then in hotels, the growth of demand has been 12%. Okay, but supply growth was 15%, which is why last 10 years, what you know is that, as everybody knows, demand was always less than supply, pricing was very soft, and the sector went through a very bad period, which culminated with COVID. Now, going forward, what you can tell is something very interesting. If you look back, on a secular basis, demand grew at 12-13%. What you can do now, looking forward, is see what supply growth is there. And supply growth, we know, is under 5% a year, because you can project it 5 years out, because there are enough consulting firms that tell you what is the state of various hotel projects in India. So we know demand growth will be north of 10%, supply growth will be south of 5%, and therefore, as you said, it's a very different scenario today, and I suspect for the next 5 years.
Okay. Typically in an industry wherein there's such a large demand-supply mismatch, and if the occupancies or the business is doing good, supplies tend to come up. Now, I know it's a long gestation business, but my question is, therefore, would be that do you foresee in your own group or otherwise there being slight aggression around capex and expansion, even if it means that it comes on stream 5 years out, or not really?
I would not, at least I can speak for Lemon Tree, we would not do that, because we are already very large asset owners. In fact, we are the third largest owners of hotel rooms in India. So typically, return on asset is the lowest in the hotel business. So the hotel business is three parts: ownership of assets, management, and brand, which is franchise. So brand returns, if you have a good brand, is 100% ROCE. Management returns are 40%. And asset returns are ultimately, on a trading basis, 8-9% linked to interest rates. So going forward, obviously, when you have a brand and you have management bandwidth, you would look at asset light. So all of us, I don't think it's only true for Lemon Tree, I think all the branded players in India are focusing on asset light, other than perhaps a Chalet, which is a asset-focused company.
Okay. In which case, sir, may I ask you that the other factor, one is, of course, the demand-supply mismatch. The other is arguably the new cost regimes that all of you have come to, maybe thanks to, maybe in part due to COVID, but even otherwise, wherein the cost structures have been brought down, asset light makes sure that your debt levels don't go up. Is that a telling difference as well for the near term to the medium term?
Very much. You're absolutely right, Neeraj. I think, every company goes through its asset-heavy growth phase. So when you take an old company like Taj or ITC or Oberoi, they went through it decades ago. Okay, whereas Lemon Tree, we are a new company. I mean, from the first hotel to today is less than 20 years. So we went through our asset-heavy side. Now everybody gets aligned after a certain time into a common strategy, which is asset light. Because asset light is what? It really means I manage other people's hotels, but I typically take something like 15% of the profit as my fees. So, it's like if I manage 6 hotels, it is effectively like owning one without any asset risk and debt. And remember, in India, very few people seem to realize this. There are over 3 million rooms in India, hotel rooms, and the branded side is only 1.6 lakhs. So think of it this way, that only 5% of India is branded. That's the opportunity.
Wow. You actually talking about the branded or organized to unorganized, so to say, in 2023 for the hotel industry.
That is correct. See, the US, 70% is branded. Of 5+ million rooms, 3.5 million rooms are branded. In India, 3 million rooms, only 150,000 are branded.
Will there be an appetite for such high-priced rooms, Mr. Keswani? Branded naturally would be higher. We're talking about much higher rates at a point of time, and even well-heeled travelers like me, for example, at times feel that the rates are extremely high currently in a lot of, say, palace hotels or safari hotels or leisure hotels, as the case may be.
See, 20 years ago, over 50% of branded supply in India was 5-star or above.
Okay.
Today, it is probably 30%. So what has happened is it is becoming, the supply side is becoming more evenly distributed from economy to mid to upper to luxury. So what's happening? What I find happening is that as we take prices up, whether 5-star or 4-star or 3-star, customers are recognizing that what they would pay for a 4-star hotel pre-COVID today is the price of a 3-star. So there is some degree of trading down. But the demand is not changing. What's happening is that really a 3-star hotel is taking its prices up, is commanding 4-star prices, and go up the ladder, and it's the same story.
Got it.
So to answer your question, you may have to stay in a lemon tree in future rather than a expensive resort.
I'll happily stay at Lemon Tree because I have the highest regard for the kind of rooms and services that your team gives, Mr. Keswani, and I mean that. Just one more slightly thematic question before I move to the near term as well. The other aspect of cost, which of course so many people have spoken about, I want to understand from you, how does it stay going ahead? Which is how during the downturn of COVID, I believe you guys reset the cost and then have brought it up to a more acceptable number for you than what it probably used to be. Do you think the new normal of the costs would stay at a much lower level than what the normal was pre-COVID?
Multiple reasons, but overall, I would say yes. So let me give you an example. We used to have, I think, 8,000 rooms and 8,000 employees pre-COVID. Now we are closer, well, above 8,000, obviously, rooms, but we have only 6,000 staff. Okay, so the staff to room ratio dropped dramatically by actually 1/3. So from 1 staff to room, today we are at 0.65. What happened? One is, I think we learned to work smarter. Number two, there was a large element of digitalization that occurred in most of the large companies, which improved productivity. And third is, I think we cut out what we felt was inessential. You see, when you're driven to the wall, remember, in the first 3 months of COVID, revenues dropped 80% for all hotel companies. So you had to find creative solutions. And that led to significant cost savings. And typically, I have discovered that cost savings are of 2 types. One is flab, which is good saving, and one is muscle, which is bad saving. So what's come back is the muscle. But the flab has gone forever. And I think from my conversations with other CEOs of listed companies, I think all are aware that we should not let that flab come back. So it's a structural change, and I think it's permanent.
In which case, while everybody is happily gasping at the kind of numbers on the Ebitda front or the margin front that companies like you and your peers are delivering, I'm trying to understand here that the cutting of flab and therefore the bad costs having gone away permanently and operating efficiencies due to digitization, which might continue, and add to that the fact that the ARRs are moving up, would it be fair to assume that what EBITDA margins exist today and which are multiple year highs or maybe decade highs or life highs for certain companies might actually not stop here, that they might actually go up from where they are right now?
See, so let's break down revenue into 3 parts: room revenue and not room revenue. So in the room revenue, when you increase prices, that's a 100% flow through to your EBITDA. When you increase occupancy, then it's a 90% flow through to EBITDA because the variable cost per room is very low.
Yeah.
Then you go to non-room income, which is food. In food, the variable cost is maybe 30-35%. So the contribution is 60-65%. So it depends on which part of your business is growing and what is the flow through to EBITDA. But the short answer is a company like us, for example, 75% of our revenue is rooms. Most five stars, it is 60% rooms and 40% others, like F&B. So the flow through will be different. But in our case, it is certainly the highest we've ever had. We have a net EBITDA north of 50%. I think Taj announced that they wanted 35% net EBITDA as a 2-year target, but achieved it in the last quarter because of flow through. So this is not let's put it this way. I suspect that after 15 years of subprime returns for the hotel industry, us coming back to this is on an averaged out basis is no great shakes. It had to happen. You see, who will put up a hotel room today or pre-COVID when your return on capital is 6%? Nobody would. So when that happens, it automatically, it's a self-regulatory control over supply.
But the industry did put up rooms then. So I'm not saying that this shouldn't happen. All I'm saying is that it did happen then. And some hotels were shut down.
Correct that, Neeraj. The fact is that the real returns the industry last got, really, on a Pareto basis was in 2004, 5, 6, 7, before the global financial crisis. The returns were so high for similar reasons like this. So like a commodity cycle, that the supply planning in India became absurd. So for the next 12 years, on an average basis, I'll give you a number. The amount of branded rooms in India between 20 years ago and today have grown 7x. Okay. And most of that happened from 2009, 10 to 2016, 17. So that was the real injection of supply, which really destroyed supply demand imbalance. See, it's an absurd thing. But if I'm planning a new hotel, I have to realize I'm creating supply. Right. So if today the dynamics in a market is there are 100 rooms and demand of 90 rooms, it's 90%, it's fabulous. But if I add another 50 rooms, then the 90 is on 150. So the numbers I look at in taking my decision are on a looking back, not a forward projection. Sure. And that is where the trouble started. But to answer your point, a lot of that supply plan came mostly till 2016, 17, and then it slowed down. So you're right, there was supply, but it's been petering out.
Got it. Okay. So, but the net effect is that even if we don't account for the rise in per capita and therefore the higher spends by Indians within India, the operational metrics might continue to look northwards and might continue to march higher for the foreseeable future.
So they always say promoters have, by definition, an optimistic outlook. Okay. And I think, well, we also have to have a risk mitigating strategy, right? So if I look at it from both perspectives, I reckon that for sure the next 4 years are a golden period for hotels. But after that, how much supply comes, who plans it, I have no idea. But I do feel that the next 4 years are going to see, in cumulative terms, more profits than in the last 20 years. So it's a Pareto. Think of it this way, that in a cycle of 10 years, in 2 years, you do most of your profit.
Yeah, sure. Okay. The 80-20, as long as it works, no complaints at all. The last couple of questions. One of them is as a promoter again, or somebody is looking at maybe the longer term, and a business which necessarily has debt as well. What would you reckon you would give more importance to with the cash flows? Debt reduction, measured expansion, or something else?
See, I would right now, based on the uncertainty that there is in the world, and I think a key learning of COVID is that what makes sense for any company like mine, which has invested very large amounts of capital in the last 10 years, is to go debt free. So use the next 2 years, 4 years cash flows, write off your debt, and then use free cash flow if you must to grow the asset side, if you must, or evaluate whether it makes more sense to simply reward shareholders if you can't give a hurdle rate of return. My personal view is that since we own so many assets already, we will go debt free. That's our focus. That's where we'll deploy cash. And we will grow asset light, where we will monetize our brand and management capabilities.
Got it. Lovely. My final question, and that is on the emphasis that so many people are giving to 2023, the G20 presidency, Cricket World Cup, foreign travel coming back, what have you. I mean, does it promise to be that large a year? And if that is the case, what about beyond 2023?
So there are two parts to your to the answer. One is the one-off. So G20 certainly will have an impact on the hotel industry, but more on the luxury side, because the kind of people who will visit will obviously stay in five-star hotels or better. As far as the structural change in demand goes, we have figures of bad years in the Indian economy, where even in the bad years, the growth was north of 10% in demand. What has changed with COVID has been that a lot of unbranded demand for unbranded rooms has now shifted to branded, very simply because people now are ready to pay a slight premium for hygiene, safety, security. Number two, one of the big demand generators for hotels is foreign travel. That is only 60-70% of what it was pre-COVID. That has to come back. Okay. So what I see happening is that excluding the one-off like a G20, there is definitely going to be a big increase in foreign inbound travelers. There is going to be a big increase in domestic consumers because they will shift from unbranded to branded. And meetings, incentives, conferences, weekend getaways have now become a part of people's behavior.
True.
So all three promise to give a big fillip to demand in the hotel industry on a structural basis.
Got it. Well, no need to talk numbers. I think this gives flavor enough, Mr. Keswani, and that's what I intended to do. So thank you so much for taking the time out and speaking to us, and all the best for a golden 5-year period, hopefully beyond that as well.
Thank you, Neeraj.
And